TD Securities is forecasting a rise in Canada's Consumer Price Index to 3.1% year-over-year in April. This would mark a slight increase from March's 2.9% and is attributed to higher energy prices and the statistical impact of the removal of federal carbon taxes in certain provinces. The base effects from the removal of carbon pricing on home heating oil and other fuels in late 2023 are now reversing in the year-ago comparison, contributing to upward pressure on the CPI. This development is notable because it suggests a potential shift in inflation dynamics, even as the Bank of Canada navigates a slowing economy. TD Securities analysts emphasize that while the headline CPI may rise above the central bank's target range, core inflation, which strips out volatile items like energy and food, is expected to remain more stable. This distinction is important because it could influence the Bank of Canada's approach to monetary policy. A 3.1% CPI reading would place inflation above the 1% to 3% target range for the first time since February, which could prompt closer scrutiny from policymakers. The central bank has been carefully balancing support for economic growth with the risk of persistent price pressures. If most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. April's CPI comes in as forecasted. It may not necessarily signal a long-term inflationary trend, but it could still raise concerns about the broader economic outlook. The Canadian dollar has been under pressure recently, trading near multi-month lows against the US dollar. A stronger-than-expected CPI reading could further weigh on the currency, especially if markets interpret the data as a sign of renewed inflationary momentum. However, TD Securities suggests the spike may be viewed as a temporary distortion rather than a structural shift. The energy sector is a key driver of the expected CPI increase, with rising global crude oil prices feeding into domestic gasoline costs. This is a direct mechanism that translates global commodity trends into domestic inflation pressures. The carbon tax base effect is another important factor. When the carbon tax was removed in late 2023, it led to a one-time downward adjustment in fuel prices. Now, as prices are compared to a period when the tax was still in place, the effect is reversed, contributing to a higher year-over-year inflation rate. This base effect is a statistical phenomenon that can temporarily distort inflation readings, even if underlying price pressures remain stable. The Bank of Canada's inflation target range is a key benchmark for policy decisions. If the CPI rises above this range, it could prompt questions about whether the central bank will need to adjust its stance. However, the analysts at TD Securities suggest that the core inflation measures, excluding volatile items, may still support a more measured policy approach. This could mean that the Bank of Canada may not respond aggressively to a single CPI spike, especially if it is seen as a temporary statistical effect. The broader economic context is also important. Canada's economy has been showing signs of slowing, which could limit the most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Central banks' ability to raise interest rates aggressively. A stronger CPI reading may not immediately translate into tighter monetary policy if the underlying economic fundamentals remain weak. The next signal to watch will be the official April CPI data release. This will provide a clearer picture of whether the forecasted 3.1% rise materializes and whether it is driven by energy prices alone or broader inflationary pressures. The Bank of Canada's response to the data will also be important, as it could signal whether the central bank sees the CPI increase as a temporary fluctuation or a more persistent trend.